Hello everyone, what a week it has been as a lower CPI data has sent the S&P 500 and other major indices higher last week. It seems like investors believe that inflation has peaked. Fed may turn less aggressive in their interest rate hike, and therefore investors are starting to pour their money into the stock market. Not sure if you are one of them. Anyway, in this video, I will share my view of the current strong rally and whether my sentiment of the market has changed from bearish to bullish. There are also some interesting stuff to discuss in terms of the stock charts and technical analysis, so do stay on to find out more. First up, a quick market recap. Economic data such as consumer price index and producer price index in recent days has kind of gave investors some assurance that inflationary pressures are beginning to cool off. Last Wednesday, when the CPI number came in lower than expected, the market soared, and by the end of the week, the US stock market has registered their longest winning streak since November 2021. Generally, it appears that positivity and optimism are seeping back into the stock market as more investors became more convinced that a soft landing can be achieved by the Fed. In other words, to avoid a severe economy downturn despite the rate hikes to tackle inflation. To add on, in the past week, sentiment survey indicated that the bullish sentiment has reached its highest level since 23rd March this year. So what's ahead? Will this rally be en route to all-time high? Well, it's possible, simply because the market is unpredictable and everything is about probability. But here is my take. 1 month of data or rally does not form the overall trend, especially when inflation remains high and Fed is still increasing interest rate with the next one coming up in September. Despite the current rally, I personally think it's good to remind ourselves the ongoing macro factors that could remain as roadblocks to the bullish market. And they are Russia-Ukraine war, US-China tension, technical recession, continuous rate hikes, inflation still at 40-year high, and of course weak earnings and forecasts by various mega-cap companies. Therefore, a part of me is excited about this rally as my long-term portfolio turns greener each day, but I still remain a little skeptical about the rally from the mid-term to longer-term point of view. And by saying that, I mean 3 to 6 months. But of course, this could change along the way, and I will continue to provide updates through my videos. But in the shorter term, most stock charts are looking bullish. This is a fact that I cannot deny because technicals don't lie. So now let's move on to the technical segment. But before that, I hope you can help to smash the like button and subscribe to my channel if you have found some value in my video. Thank you. The benchmark of the broad market S&P 500 has rebounded about 16% since mid-June. Heavyweight Apple has rallied more than 30% since it hit its low of about 129 on 16 June. To add on, it is currently less than 6% away from its all-time high. Then we have the VIX, aka the Fear Index, dropping to near 4-month low. So that's positive news for long-term investors like us. But part of me remains cautious due to the various gaps spotted. Just to share, though it does not always happen, such bull gap up usually gets filled. And I would say 90% of the time, but who knows, this time could be the other 10%. Therefore, to determine whether we belong to the 90 or the 10%, as usual, take cues from the various key support and resistance levels, and of course combine it with other technical aspects or analysis where possible. Okay, let's start things off with SPX and SPY. As shared earlier, the broader market SPX has rallied hard. And interestingly, a technical analyst called Jonathan Krinsky from BTIG shared that since 1950, there has never been a bear market rally that exceeded the 50% Fibonacci retracement level and then gone on to make new cycle lows. So as you can see from this chart, SPX has broken above that level, which is 4227. And if history is of any indication, then the bottom could be in already. But if we were to create another new low, then we are actually making a history here. Nevertheless, the next resistance will be the 200 moving average at 4328 and the crucial 61.8 Fibonacci level at 4367. For those who buy SPY, these numbers translate to 429 for 200 moving average and 433 for the 61.8 Fibonacci retracement level. Personally, I am expecting sellers to step in at either of these levels and we may get a pullback. That's when investors can consider dipping their toes into the market if they believe that the market has bottomed in June, or they simply just want to put their money to use. And I could be one of them, but not for SPY, more for the other stocks that I want to acquire. Lastly, I would think the 50% Fibonacci level at 419 should offer some form of support. That being said, to highlight, there is a gap between 412 to 416, so don't be surprised if SPY move downwards to fill it. Moving on to Apple. Apple had 6 straight weeks of green candle, looking very bullish as it leads the market rally. Previously, I've shared on Moomoo that once 161 resistance is breached, we can fly all the way to 173. Apple is currently sitting at 172. Once again, this shows how support and resistance levels work, and if you had caught my video or post, you would have been able to ride this uptrend. Anyway, the next resistance is at around 176. If that breaks, we could fly and go close or retest its all-time high. On the downside, the 200 moving average will act as a support at around 159, after which the next support is at around 155 where the 50% Fibonacci retracement level is. I think this could be a good opportunity to pick up a few shares if it pulls back to this range. Personally, I am not picking up any shares in the 160s and 170s range as the valuation is too high in my opinion. Alright, for Tesla, a bull flag seems to appear on the chart, which is a bullish sign. To add on, there seems to be a cup and handle pattern too, which also is a bullish pattern. If either one of them plays out, then we could fly higher from this point. To recap, in my last video, I have shared that even if the stock goes as high as about 1050 plus minus a little bit, it would not surprise me as we are still in this huge downward channel. Anything within this channel is not something we should be shocked about. Resistance wise, the upcoming one would be the 200 moving average at 909. At the moment, it seems to be chopping around 900 plus minus range. So we will need to see a breakout of the bull flag or cup and handle pattern. Then we will have the chance to charge towards 1000 mark. Okay, amongst the various mega cap stocks, Google seems to be the most disciplined and perhaps predictable one. Why so? As you can see from this chart, it just chopped around this consolidation zone in a zigzag manner. Every time it went up, kissed 120, it came down. So if the trend remains this predictable, then I think the next move will be down. That being said, nothing is guaranteed, so watch how it moves in early next week. And it is currently sitting on top of 120, which now acts as a form of support. If the broader market wants to go up, Google may finally break away from this huge resistance of 120, and the next strong resistance is around 125. On the downside, if it follows the same zigzag pattern and goes down, as long as we don't break below 100, I think we are fine. Here are my end thoughts. I have earlier summarized the existing macro factors that could continue to hurt the stock market. With those factors still in play, my view is that the current melt-up in the stock market is more of a sentiment rally than anything to do with fundamentals or macro. I also wanted to take this opportunity to highlight that Fed could raise 50 basis points by all means in September instead of a more aggressive 75 basis points. But in this new paradigm of rising interest rates, valuation of companies, especially the tech companies, will be very high. Take Apple for instance, the rising stock price has sent its share back to an expensive territory. Its current PE ratio is close to 28. And to put things in context, it was about 23 in June this year and has an average of less than 20 before 2020, the year where the Fed started to pump money into the economy. So do bear this in mind as you start to buy these stocks at high price in this high inflation environment. Also, I wanted to remind everyone that we are also dealing with a high volatility environment, and volatility can work both ways. This means we can rally hard now, at the same time we can fall pretty fast too. At this point, I think it can be tough and lonely to go against the crowd. Lots of investors are pouring their money back into the stock market, but I was staying on the sidelines for the past 2 months. I did not buy any stocks and did minimal option trading, therefore the FOMO can be real. But of course, I always emphasize that one has to be nimble and not to be too stubborn. Therefore, I stand corrected. For instance, I admit that I did not expect the rally to be so strong. Therefore, I am convinced that the short-term market is bullish now. But this is simply because the technicals are showing me so, not because everyone is re-entering the stock market. So here is my upcoming plan, but please don't follow blindly, alright? Because the technicals are showing bullish signals, I am planning to get back in bit by bit and load up shares for my long-term portfolio. But to clarify, I am not going to chase the current euphoria or this raging bull. Anyway, the market will have to pull back at some point in time. This is not a prediction, it's simply because market doesn't go up in a straight line. So when it starts its pullback, I will pick up a few shares here and there at my own desired price. And when the pullback happens, I will pay very close attention to whether the indices and various mega cap stocks bounce off their support levels. If they do, it means the rally will sustain. If they don't and they fall further down, I will continue to buy at a more aggressive pace. Finally, I have been preaching this method, DCA, or buy the dips in tranches if you are a long-term investor. Previously, it was difficult to explain why it works despite showing this article on the right to viewers, where it says even God can't beat DCA. So now I think the current market presents a good example to show that no one can accurately pick the exact bottom. I mean, the market has rallied over the last 1 month. Did you buy the dip when it was at the very bottom, or right before it reversed? Or are you FOMOing and chasing the rally now? Or are you still holding cash because you think that this is a fake rally or a dead cat bounce? The current rally shows that the market can rebound so quickly that you may miss the dip altogether, or you may treat the reversal as a bear market rally. To be frank, nobody knows where the current market is heading to. There is always two conflicting groups of investors. On one end, we have investors who believe the bottom was in, but on the other side, we also have investors, including myself, who feel that the macro is still weak and we are not ready for a bull market yet. Therefore, going back to buying the dip via DCA or in tranches, I feel this method works best for long-term investors. To share, personally, I had purchased some shares at the following price before June, when many people were still holding cash. So for Apple, I bought it at 133, 140 and 155, Microsoft at 264.5 and 266, and a few Tesla shares at 670, 724, 785 and 880, and for Nvidia it's at about 195. And I'm glad that I've done so because except for Nvidia, the rest are all in the greens now. This ensures that I don't miss out much with the current rally as I wait for the next pullback. But if my overall sensing is correct, then the market could go further down and I will still continue to buy that dip. Who knows, there may be a dump when people get bullish. Alright, that's all for this video. Hope you have learned something today and I also hope my content has value add to your research. If it does, please help to hit the like and subscribe buttons. Thank you.